Today, you will finally find out why you have been lied to when it comes to building your investment strategy. We will explore why the argument that says growth gives you a better total return is a lie the majority of the time, and I will show you how financial media and other so-called gurus are manipulating you into thinking in such a way by showing you hard numbers that no one can argue with. See, when people show you charts of different companies or funds, you have to know that there are two types of charts: price performance charts and total return charts. And with the total return charts, you have to make sure that the provider of the chart has taken into account the reinvestment of the dividend, because a lot of them don't do it. You see, most of the videos or articles show you the simple price return chart, and then they try to convince you that this or that investment is better than the others. Or they show you a total return chart, but for some reason the total return doesn't account for your dividends buying new shares, which gives you more dividends, buying more shares, etc., producing the so-called dividend snowball compounding effect. In order to illustrate the dramatic difference between the two methods, I have prepared a couple of charts. In them, I will show you three popular, relatively high-yielding dividend stocks versus the Vanguard Growth Index ETF, ticker symbol VUG. Now, I don't want you to get bogged down into the practical examples. And no, I'm not cherry-picking companies to prove my thesis. The point is to illustrate mathematical principles that otherwise would be too complex to understand with real-world examples. I chose this ETF because it is one of the largest growth ETFs and is a representation of growth stocks in general, although it does pay a very small dividend. Okay, so let's load the charts. I will start with comparing VUG with one of the most popular business development companies out there, RS Capital, ticker symbol ARCC, which is known for its high dividend yield. This is what you would typically see on the internet. As you can see on the chart, the growth ETF crushes RS Capital with 531.72% total return versus RS 217.69% total return. A new investor sees that on a video or by looking at a simple Google search result chart and is thinking, this is a no-brainer. Is it though? Well, here is the actual chart people need to be looking at. The results are a lot different now. Turns out, a boring business development company with share price has gone almost nowhere actually beats a growth ETF that has all the big tech companies in it. Here, RS returns 776.21% versus VUG 622.85%. The difference is, in the second example, the dividends have been reinvested to buy you more shares that give you more dividends, with which you buy more shares, etc. Let's continue. Here is a second example. Now, I will compare VUG with one of the favorite stocks of the dividend investing community, the real estate investment trust Realty Income, ticker symbol O, with a current dividend yield of 5% at the time of recording the video. As you can see, in the normal chart you would see in Google or Yahoo, etc., VUG beats Realty Income with a significant amount, turning $10,000 investment into $60,822 versus Realty Income's $50,571. But if we are looking at the chart with the dividends reinvested, then the picture is quite different, and we see that Realty Income has turned this $10,000 into $82,793 versus the fund's $69,772. Okay, one more example. Another dividend favorite, the tobacco giant Altria, with a current yield of 8.5%. Let's see what the comparison will tell us. As you can see, again, the normal chart shows Altria giving you 5.82% return versus VUG 9.79%. However, with dividends reinvested, you can see Altria's annual return changing to 12.82% versus VUG's 10.58%. And the tobacco giant is crushing the growth ETF by turning $10,000 into $103,000 versus the ETF's $70,000. Even the almighty S&P 500 loses the battle against these dividend companies when dividends are reinvested. Here is the S&P 500 versus RS Capital, with the business development company beating it with over 300% when dividends are reinvested. Here is a comparison with Realty Income, with the REIT crushing the S&P 500, and also a comparison with Altria, showing that if you compare the S&P 500 with the tobacco company only on price, the ETF is beating it. But when you factor in the reinvested dividends, Altria is actually again crushing SPY. Again, the point is not to say that it is better to invest in one company than an entire index of hundreds of stocks. Far from it. The idea is to show you how a good cash flowing investment actually crushes the alternatives if you're looking at the chart the proper and complete way. Why do you have to look at it that way, you might ask? Isn't the goal of the dividend to get it in my bank account so I can spend it? Well, you know the old saying that you have to compare apples to apples, right? If you're going to wait 30 years without touching your investment and benefiting from it in any way, as the growth investors suggest you should, then it is only fair to compare this apple to another apple and see the results for the same time period without benefiting from your dividend as well. Again, you can't compare an apple to an orange. And in the case with dividend investing, the great benefit is that the moment you decide to stop, you have a stream of cash flow that you can decide to pay for your life or not. And that option, unlike with growth investing, is always there and you can switch it on or off. Now, there is something I need to confess to you. Sometimes I have the weird ability to see what other people are thinking. And what a lot of you are thinking right now is taxes. You're wondering why I have not explained anything about them. Well, the reason is the following. When I teach you anything about investing, I can work with numbers and circumstances that are the same for everyone, everywhere. I don't care where you're watching this from, what is your income, and whether you are married or not. The charts I showed you are the same. But the reason I don't like to talk about taxes is that it is such an individual and diverse topic that there really is no point. This video will be watched by thousands of people in potentially 100 countries. Each country has its own tax laws. And even within the same country, there might be different tax brackets. It might matter whether you are married. Maybe you have some real estate that you can use as a depreciation. Some countries have more favorable tax treatments of dividends than capital gains, or even zero taxes on them. Others have the option to invest in a retirement account where you can get the dividends and reinvest them, achieving the same exact results from the previous charts without paying any taxes. The point is, I don't know where you are and what your situation is. Taxes are the easiest thing to solve. Every local accountant that did not buy their degree is going to be able to tell you how much you should pay. So, with that said, I will move on. Apart from showing you how a good dividend company can crush a growth-oriented one, if you are looking at the right chart in the right way, I need to disclose that at the moment of making the video, I own shares in all 3 dividend companies I showed you. But I own a lot more. And I can tell you from experience that besides knowing that when I reinvest my dividends, I will probably outperform the passively managed growth funds over the long term, there is one other significant advantage of having a cash-flowing, dividend-oriented portfolio. We already talked about the issue with having to sell shares in a bear market, or how it can cause you to panic when you don't receive any cash, but are watching your stock price go down. Well, I had the perfect experience to prove my point. In the bear market of 2022, more than half of my 40-plus stocks and ETFs went down, some with significant percentages of 20, 30%, etc. However, I couldn't care less. I was actually excited because I could buy more shares at a discounted price with my dividends. And out of these more than 40 companies and funds, only 3 cut their dividend, and these 3 were my most speculative ones anyway, so I did not have that much exposure to them. All the others kept it, and a lot of them actually even increased it. So in the worst bear market in over a decade, when people were watching their growth stocks getting destroyed, I was actually watching my cash flow increase and was sleeping well. So all the things I am telling you in this video are actually coming from experience. If you would like to see my favorite 4 stocks I invest in right now, you can check the link in the description. I will send you a report with them, which will be up to date regardless of when you watch this video, because I am constantly updating it.